Welcome to TheoTrade. This is Don Kaufman. March 30th, 2022. Hour after the cash close here on this Wednesday afternoon. S&P's down about 0.5%. The Nasdaq off 0.9%. Of course, a little sell side activity. And that's all that this really is a little sell side activity. In the midst of what has been an absolute rip your face off rally. Nevertheless, even the most mild of selling right now just bombards that kind of question. Will the bears return to this marketplace? So we're going to get right down to business and explore what I believe is a very critical aspect in trying to answer that question. There is a very substantial divergence underway inside of the credit markets versus, if you will, the S&Ps. And what I'm really referencing, and of course, let's just throw it out there, it's bonds, okay? So what is at issue in the bond market? Obviously, the bonds have had some pretty hideous sell-side activity. And with bonds having that hideous sell-side activity, well, interest rates, and we'll go ahead and pull up TNX, which is representative of the 10-year, has effectively exploded. I mean, a lot of people don't necessarily look at it this way, and you can talk about what the interest rate happens to be on the 10-year. Pretty much you're blue in the face right now. It's 2.35. That's a decent move. Well, how much, though, has it actually moved? Well, the answer to that is, on a year-to-date basis, you're up about 45%. So for the most part, the 10-year has exploded by the tune of about 45%. Again, it's a decent percentage move, especially when you start to compare that to, there's not too many stocks on your screen that have moved that much. You bring up Tesla. Oh, that's still down on the year. I tried. You bring up something like Apple, which has had just an amazing rally. I think it was down almost 20%. Now it's only down 2%. But the point that I'm trying to make is, obviously, there's issues inside of the treasury market. But again, right down to business. Everybody in the industry right now happens to be referencing, well, an inversion in the yield curve. So let me explain precisely what you're looking at, okay? And then we'll talk just briefly about the inversion of the yield curve, because I'm going to tell you right now, this has just been probably the most, over-conversed topic in the last few days. So the FVX here, and you guys can pull this up for yourself, but the FVX is actually representative of the 5-year. The TNX, of course, is the 10-year, and then the TYX, of course, is the 30-year. And you can see, the 5-year is sitting at about, let's call it 2.6. Here we are at 2.5. And then the 30 years back at about, we'll call it 2.64. So this, in effect, is what we call an inverted yield curve. The 5-year, the percentage, okay, is actually above, of course, the 10-year. And the magic signal, if you will, for a looming recession would actually be like the 2-year, okay, versus the 10-year. And ironically, even those inverted for a brief and fleeting moment. And again, I'm not telling you probably anything that you haven't seen before. So what's the cause for concern? All right, so after, some people look at the 5 versus the 10, the 5 versus the 30. I think the marquee, though, in the industry is probably the 2 versus the 10. After we see the yield curve inversion, you're on the clock for a recession, okay? You know what? Neither here nor there. If you listen to Jerome Powell, it is not a cause for concern. Well, let me bring to light what may actually be a little bit of a cause for concern. First and foremost, we're going to go ahead and bring up the TLT. Now, we can look at the bonds. You can look at the ZB. You can look at the ZN. You can look at this in, 50 different ways if it does it for you. Nevertheless, I'm going to bring up the TLT, and obviously some pretty wicked sell-side activity in the TLT, but I'm going to show you just a bit of a different look, and we're going to go over here to studies. We're going to go to add study. We're going to go to volatility studies. I'm just going to cruise up to implied vol. We're going to start with implied volatility. Then I'm going to go ahead and knock off its volume subgraph. Hit apply, hit OK. All I want to show you right now, okay, is, well, bond volatility. Okay, and bond volatility, and there's like a really, I guess, interesting irony with this. and probably the easiest way to explain it. When you look at implied volatility, by the way, here on thinkorswim specifically, this isn't just any implied volatility. This is what we call a VIX style 30-day day, okay, implied vol. So it's a VIX style 30-day implied volatility. And it's roughly at, let's just call it 21%. So 30-day implied volatility in the TLT is roughly 21%. Where's the VIX? 19. Does anybody see an issue with that? You have bond volatility, credit markets, treasuries. Bond volatility is now effectively above, well, S&P 500 volatility. Okay, I don't know about you, but I got a lot of problems with this, people. It's a huge issue. In fact, when you actually start to pull it up on a more significant time frame, we can pull up like a 3-year. So this huge spike over here, this is welcome to the Fed. No, that was actually the onset of COVID. It was the onset of COVID, and it was the Fed that actually squashed the volatility. But you're looking right now, in the last 3 years, one of the most serious instances of vol. I mean, so you can pull up in this area right in here. This is like, February into March 2021, and go ahead and compare it to the spiders. You can bring up February or March, of 2021. And again, it's not so much about implied volatility, right? And I'm just going to zoom in here for just a second. All right, so February, March of 2021, which is right in this neighborhood here, okay? There was a fairly dramatic dip inside of the S&Ps, but the point that I'm trying to make with this is that extreme volatility inside of the bond market, in almost every case in recent history, has actually been met with extreme volatility, okay, inside, of course, the S&P 500. Now, I just opened up to a full-blown 10-year chart. And the reason I wanted to show you, now you can see what it is I'm talking about. This, okay, is really, really extreme. Even that other spike in here, all right, but it was nothing in comparison to the sustained, okay, and high implied volatility. The point being is, if you've ever listened to traders over the years, they always say, oh, the smart money is in the treasuries. No, the smart money, okay, runs and starts to move capital. In the midst of geopolitical risk, war, the bonds typically know something is coming before the rest of the marketplace knows, right? If there's massive hedging activity, by the way, that was not an implication that there's, forthcoming war. I mean, obviously, that's, the onset of that is well known. But the implication over here is simply that this volatility, if it doesn't reside, okay, very, very quickly inside of the TLT, you're in trouble in the S&Ps. Okay, credit markets, okay, can see risk pretty clearly at this point in time. And again, those implications are just negative for the S&Ps. It just means volatility is going to come raging back. So, will the bears return to the marketplace? It doesn't necessarily mean that we're going to go spiraling out of control. Everybody loves these like marquee definitions. We never officially hit a bear market in the S&Ps. No, we didn't, but we did inside of the Nasdaq. All right, the Nasdaq actually did hit, if you will, in a year-to-date percentage. We did hit that, oh so important 20% down move. But ironically, now it's a fresh start. Okay, we're seeing green shoots already. Nevertheless, okay, the point being over here, at this point in time, and again, I've been criticized, a tremendous amount for saying this. Okay. Yes, it is a rally inside of the S&Ps. Yes, it's a rally inside of the QQQs. But we're not so sure just yet what kind of a rally this is. This rally is highly likely to be that quintessential rip your face off bear market rally. And you got to look, okay, not just at the obvious. I'm looking at the MACD and the Fibonacci and the Bollinger Band. Don't look at the obvious. Look at the implied volatility. I don't make any decision in this business by looking, for instance, at one product or one chart. The decision I'm making right now, okay, is to take a very detailed look at other markets. And there's something clearly wrong. You can see it in the commodities, volatility's through the roof. You can see it inside of the bonds. From there, make some of your own, decisions on that particular front. Whatever you do, keep your risk under wraps, under control. because in the near future, again, it's very likely you're going to see some fairly tumultuous volatility hitting the S&Ps. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.